Hi everyone, I'm Paul and welcome to my review of ICT's 2022 Mentorship Program Lesson 6. There's been quite a few people in the comments asking me to go into more detail on fair value gaps and on market structure shifts. So if that's you, I've got great news for you because today's video is a deep dive into both. So please like, subscribe and let's jump into the video. So today's video is the review of Lesson 6 of the 2022 ICT Mentorship Program. And we'll just start with a brief outline. So the first section is how ICT internalises price delivery, and then we get to the real meat of the video, which is about the ICT fair value gap. And we go over both the bearish and the bullish fair value gaps. And then we also talk about market structure shifts and again look at the bearish and bullish setups of both. And we use a trade example, this time from the NASDAQ from the 3rd of February 2022. And then we've also got a section on managing exits. So the first section is how ICT internalises price delivery. So I guess you could say this is the underlying principles which I guess drive ICT's approach to trading the markets. And so, if you're going to follow his methodologies, then it's, I guess, good to understand how he thinks about the market. These aren't necessarily my views, but this is obviously what he thinks. And I think it's valuable to have that insight when you're then implementing some of these strategies in the marketplace, because this is obviously the ethos, if you like, for how he is approaching the market. So the first 2 points kind of go hand in hand, and that's, we don't trade patterns for pattern's sake. We do not trade indicator readings or momentum. So you know from ICT's videos that he basically trades a naked chart. He might draw some lines on there. That's generally for educative purposes, but he doesn't have any indicators on his chart. He just basically has the price bars, and that's about it. And so fundamentally, we're looking to enter long positions where retail is selling, and conversely, we're looking to enter short positions where retail is longing. And so what do we mean by retail? So retail traders often in trading circles are kind of used as a bit of a derogatory term, and the reality is most of us who are trading through a broker or an exchange, depending on what markets you're trading, are retail traders. I myself am a retail trader. Obviously don't work for an institution or anything like that. And often people call people retail traders or dumb money or uninformed traders, and that's probably not necessarily true of everyone, but I guess as a bucket, we know that the majority of retail traders are not very well informed, not necessarily well educated, and typically, they'll lose. 80% of traders, or there's some figure like that, will blow up their accounts and either never come back or come back and blow up their accounts again. So what we do know is the majority of retail traders aren't in the market for a long term. And so logically then, we don't want to do what they're doing. We want to pretty much be doing the opposite of what they're doing. And so the converse of this is, we refer to smart money. And so that's often seen as an institutional view. And the institutions or smart money don't look at patterns or indicators. And, they're primarily concerned with time and price, with time being one of the most important factors in the way that they approach their trading. And so it follows then that if retail traders are going to be losing in the market and they're not going to last and they're obviously going to turn over their accounts, then the smart money or the informed money is going to be looked to be taking advantage of those speculative and uninformed traders because they're generally going to have the wrong bias in the market. They're not going to be using stops properly or not be using them at all. And so smart money really looks at this pool of traders as a source of liquidity. So, we know with institutional or smart money traders that they need significant size to get set in their positions. And so they're going to use this pool of traders as a source of liquidity so that they can get set and then they can execute on their specific bias. And so it follows then that, part of ICT's underpinnings is that we should be anticipate price seeking that opposing liquidity, and that, as we said with smart money, the time of day is vital when engaging with price. So moving on now to our ICT bullish fair value gap. So remember, our fair value gap's always a 3-candle formation, and the fair value gap is found across the body of the second candle, and that's in between the first and the third ones, obviously. So optimal entry for a bullish fair value gap is always going to be found after a run into sell side liquidity at the previous lows. So remember, this is where retail traders are going to be going long and they'll have their sell stops there. So that's what's generating that liquidity opportunity. Fair value gap is typically found above a single price low or a multi-price low or a double bottom. So we'll just have a look at an example now. So this is Bitcoin on the 15th of April on the 4-minute chart. So in our example here, we can see the setup of the fair value gap on this 4-minute chart for Bitcoin on the 15th of April. So you can see at the bottom here, this is our previous low. And so this is where the liquidity is residing. So this is where those sell stops are, because retail traders going long here, looking at this as support, and they obviously have their stops down here. So being long, they'll be sell stops, which would flatten their positions. So you can see we run down into these previous lows. So that's our optimal setup for a fair value gap. And we can see just above that, we have our 3-candle pattern formation. So our first candle is this down candle here. And you can see the second candle is that displacement bar we're looking for. So that's that single candle which has a powerful move, and you can see that this breaks market structure. So we have this swing high here, so that's a 3-candle pattern where we have the middle candle with the higher high of the other 2 highs of the candles each side of it, and this candle breaks market structure, so it breaks above the high of that candle. And then the third candle, which is this one, it's like obviously quite a large one, is that forms then the top of the fair value gap. So our fair value gap is formed across the body of that second candle, and it starts from the high of the first candle and the low of that third candle. And so you can see in this particular trade, the market traded down into that liquidity, came back up again, formed this fair value gap. Now, one of the other points that ICT mentioned in that lesson 6 video is that the stop placement does have some flexibility. So in some of my previous videos where I talked about my experiences trading the fair value gap in Bitcoin, is that I often found that the market would overshoot just slightly. I would take out my stop down here at either the first or the second candle, which is where I've been placing my stops. And so in that video, ICT mentions that you can actually put your stop at the swing low. So you can see I've done that here, and that obviously just gives you a little bit more room for that trade to breathe in case it overshoots. Now in this example, that doesn't happen. The market trades up, and you can see here the market trades into this fair value gap. So if you'd gotten set by having your limit order at the low of that third candle, you obviously would have entered this trade here. Now I think just for interest, I just marked out sort of what kind of return you would have gotten on this, and it would have been easily a 2R return. I think it was actually a little bit more than that. So again, that's a great setup, and this is a good example of what that fair value gap looks like in practice. And so in that example, we touched about the market structure shift. And so going into a bit more detail on that now, what we're looking for is for price to fall below a previous lower lows. So that's pushing down into that liquidity from where those retail sell stops are, and then quickly shift higher. And so that's what that move in the fair value gap is all about. So this move should be quick with noticeable displacement. So you saw in that example, that candle, is quite powerful, and it's not a small move. It doesn't have a weak, it's not a weak candle with a little wick or anything like that. It's very noticeable on the chart. It really stands out. And so the fair value gap is going to be found between the displacement high and the displacement low. So let's just take a little quick look at what that would look like and just reference that back to the example we just went through. So this is just a little diagram describing that bullish market structure shift. And so what we're looking for is we have price come down, and obviously it creates that previous low. So that's this previous low up here before the market trades higher, and that creates your displacement high. So we then have the market trade down past that previous low into that liquidity, and then we have this powerful move upwards. So this is this displacement candle that we're looking for, and this is where our fair value gap will be formed. So if we look at that in the actual example that we looked at, we would have this push down and then this push up, and so this is obviously where we have our displacement low and high, and the fair value gap is formed in between there. So this is just a generic diagram showing the push down into liquidity at these previous lows, and then we have our big move upward with a displacement high, and then our fair value gap is going to be found in between that. So the most important thing really is this push down into the liquidity, and then the fair value gap being formed on a displacement candle on the way up. And the form of that displacement candle is important, as I mentioned before in the video, we don't want this to be a weak or tepid candle. We want it to be a powerful one. So if we zoom in, as I said, you can clearly see the strength of this candle is obviously another strong one here. And there's, a fair value gap formed there as well. But this is the one we're really looking at. We have this powerful candle. It breaks the swing high here. So this candle breaks the high of that. And that's our indication that we have a bullish market structure shift, our fair value gap set up, and then all we need is for price to trade back into that zone to get set, which is what happened in this example. So our ICT bearish fair value gap is just the opposite of our bullish fair value gap, as you'd expect. So again, it's a 3 candle formation, and that fair value gap is found across the body of the second candle and is formed by the first and third candles. Our optimal entry for a bearish fair value gap is going to be a run into buy side liquidity, which is at the previous highs or above those previous highs. And this is where retail traders are going to be going short, and so their buy stops reside there. That's where our liquidity is. Our fair value gap's typically found below a single price high or a multi-price high or a double top. And so the example we're going to be looking at is Bitcoin on the 16th of April 2022. So this is our example for the bearish fair value gap setup, and I'm using the 1 minute chart for Bitcoin on the 16th of April 2022. So you can see I've marked out the previous high here. So this is where our liquidity is going to be residing. So remember, we'll have retail traders trying to go short here because they'll see this as resistance, and they'll have their buy stops sitting in the background here, and that's the liquidity source that we're going to be looking to take advantage of. So we have a run into that liquidity, and then as the market trades back down, remember we're looking for that powerful move down, so we're looking at a powerful displacement down, and our fair value gap setup is that 3 candle formation. So in this example, we have the first candle here, the second candle, and then this third candle here, and our fair value gap is formed between the low of the first candle and the high of the third candle. And in this example, given it's a 1 minute chart, you can see that's the whole body of that second candle. And so our fair value gap is formed right there. And this move down, this 3 candle fair value gap formation move down, you can see that then breaks market structure because the low of this move is lower than the low of the swing low. And so we then have our market structure shift, and all we need is for price to trade back into that zone, which is exactly what happens here. So that allows us to get set, and then the market trails away after that. So again, in this example, I chose to place the stop or illustrate where the stop would be at the swing high. So in this case, as we've got a swing high here, but according to the other rules, you can put your stop at the first candle, and depending on what the formation of that second candle looks like, because sometimes you do get in this example, like a higher high of that second candle, and so you might want to place your stop there. So there is that variability now. ICT's elaborated on that, so you can place your stop at the local swing high or low, depending on which setup you're looking for. And so again, you can see this particular trade would have been really quite a lucrative one if we'd set our entry at the high of this candle. So we would have been had a limit order to go short here at the high of this candle. You can see if we'd been able to capture all of this particular move, this would have been a really great trade over a 5R return. So again, demonstrates the value of this setup if it's executed well. And so our bearish market structure shift, to go into a bit more detail on that, so we'll see price rally above a previous high or highs and then quickly shift lower. So again, just with our bullish market structure shift, that move should be quick and there should be noticeable displacement. So again, it can't be a little tepid weak candle. It needs to be a powerful move. It should be a candle that's quite obvious on the chart with the backdrop of the moves prior to that. And so our fair value gap will be found between the displacement high and the displacement low. And so again, just a diagram to illustrate that market structure shift. So what we have is price moving up, and this is those previous highs that we were talking about that we have up here. So this is where our liquidity is where our buy stops are going to reside. The market trades back down, and then it trades up into that source of liquidity. So it pierces that liquidity and trades higher, and this is our displacement high. So as the market trades down, this is that displacement we're looking for. So they should be obvious candles. So if we look at this example here, Again, you can see this move is quite clear. This is a powerful candle. It's not a small, weak one. And so that's what we're looking for in this zone between the displacement high and the displacement low. There should be a powerful candle here, and our fair value gap is going to reside in that zone. And so next we're going to run through the example that ICT used in his video, which was on the NASDAQ for the 3rd of February. And so we'll start on the 15-minute chart. And what I've done is I've already marked it all out here. And so what you can see is we've got the beginning of the session here, and we've got 8:30 marked here. So remember, what ICT is looking for in his setups is the local high or low prior to 8:30, and he's looking for a move post that 8:30 part of the session. So in that morning session, either up into a previous high or down into a previous low. So he's just really looking to the left of that 8:30 open for his, marker, I guess you could call it, and then looking to the market to trade into those zones after that 8:30 period. So in this example, ICT said he had a bearish bias going into the session, so he'd obviously be looking for bearish setups. And remember, we'll often see the market trade in the opposite direction prior to that sort of bias that we're looking for. So you can see that happens in this example. So you can see prior to 8:30, we have these equal highs. So this is where our liquidity or buy stops will be residing. So I've just drawn a line across. So you can see as that morning session has started to unwind, the market's traded lower and then immediately traded higher back into this source of liquidity up here. So this is our area of interest, and this is where our fair value gap setup is going to be found. So zooming in now to the 3-minute chart on the NASDAQ. Now I've had to switch over to the NDX because my data doesn't go back far enough to use the NQ, but this is pretty similar, so you'll be able to see this setup. So you can see this is a zoom in of that area of interest on the 15-minute chart. So we have this previous highs, this is liquidity where those buy stops are residing. We can see the market trades up into that liquidity zone and then starts to immediately trade lower. So what you can see happens here is we don't have the fair value gap form up here at the highs. It sort of trades down lower. So we get this swing low here, this 3-candle formation here. So this is the lowest low of these 2 candles here on each side. Then we have our fair value gap form immediately after. So our first candle is here, and then the second candle, and you can see the fair value gap is formed between our 3rd candle and our 1st candle. So at the low of the 1st candle and at the high of that 3rd candle. And you can see this move, this 2nd candle, breaks market structure. So the low of this candle is lower than the swing low here. So we have that break in market structure. The market then trades down. You can see it takes a little bit of time, but eventually trades back up into that fair value gap. You can see it trades quite close to the stop here before trending lower. So I've just marked this up. So if you'd actually taken this trade and you'd gone short at the high of that 3rd candle, you can see you would have got over a 4R return on this particular trade. So this isn't even extracting the full move. You can see the market trades lower throughout the session, significantly lower. But even if you'd just taken the first sort of lion's share of that move, that would have been over a 4R, probably a 5R return. So, that's obviously a great result for this particular setup. And so that last section provides a great segue into our last part of the video, which is managing exits. Now, probably one of the most important things I took out of lesson 6 from ICT's video was the importance of taking partial profits and that you shouldn't roll your stops. Now, I generally roll my stops and I don't particularly like doing exits that way. And so it's not that I didn't know that taking partial profits was a thing, obviously I did, but I just always been sort of trained to roll my stops and to sort of protect my risk, as you'd like. And so when he started describing the principle, I guess, of leaving your stop at its original placement and then using partial profits as your mechanism to control your risk, that sounded much better to me. And obviously because I trade crypto too, that's also actually from a fee perspective a much more economic way of doing it. So I'm going to start doing that in my trading, and I'll relay back to anyone who's interested how that goes. So the other thing he recommended was to take the range of the day, so using your 50% FIB, and then you should be looking to take partial profits at the internal range liquidity. The internal range is just basically the the middle of that, around that 50% level of the fib. So between the range of the day, between the high and the low that's formed so far in the session. And there should be a fair value gap near that 50% level. And I'd actually never noticed that before. And now since I've started doing this on all my charts, I see it all the time. So it's quite interesting, the things that are in plain sight that you just don't notice. And so you should then look to close out the remainder of your position at the external range liquidity. So that's either at the range highs or at the range lows. So there you go, there's my review of lesson 6 of ICT's 2022 mentorship program. I hope you enjoyed that. And if you were looking for a video with more information on fair value gaps and market structure shifts, I hope that helped you out. And I think there was a number of really valuable insights into developing the framework and the setup better that ICT shared in that video. So I think the one about how to use stops, so using either the swing high or swing low as an alternate place to put your stop rather than on the first or second candle at that fair value gap, that's something that's really helpful, because that's something that I know in my testing wasn't really working as well as I would have liked it. So it's definitely something that I'm going to be testing going forward. And the other thing that I also thought was really helpful was just to illuminate taking partial profits rather than rolling stops as an alternative for exit. So that's another thing that I'll definitely be using. And so all these little tidbits are really helpful just to layer on the existing body of knowledge that we have about fair value gaps and market structure shifts from what ICT's taught so far. So if you enjoyed this video, it'd be great if you could like it. And if you'd like to see more videos like this, please subscribe to my channel. Really looking forward to the next lesson, and I'll see you in the next video.